Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. I hope you all had a productive week and have a relaxing weekend ahead of you. With less than 2 days before their temporary safe haven status was set to expire, US President Joe Biden yesterday, Thursday, announced that the United States will extend Hong Kongers' refuge in the country by 2 years. During the announcement, Biden wrote that China, quote, has continued its assault on Hong Kong's autonomy, undermining its remaining democratic processes and institutions, imposing limits on academic freedom, and cracking down on freedom of the press, end quote. He added that since China imposed a national security law on Hong Kong back in June 2020, 120 opposition politicians and activists have been detained. The so-called Deferred Enforcement Departure Program allows Hong Kong citizens facing, quote, potential political repression from China, end quote, to remain in the United States. The US allowed Hong Kong citizens to take advantage of the program after the passage of the previously mentioned national security law. Several NGOs, including the so-called Hong Kong Democracy Council, as well as Human Rights Watch, have praised the decision, while calling on lawmakers to find, quote, longer-term solutions, end quote. Some academics and analysts are calling for more to be done generally. Quote, if we are serious about the commitment to supporting democracy around the world, there are few better examples of people who are seeking freedom than those who have left Hong Kong because of Beijing's reneging on its 1997 commitment to the people of Hong Kong to one country, two systems. This decision sends a powerful message to Beijing and the people of Hong Kong that will not go unnoticed, end quote. Meanwhile, on the theme of US-China relations and the Hong Kong Special Administrative Region, on Wednesday, Gregory May, the newly appointed US Consul General in Hong Kong, warned that companies in the territory face heightened risks, including to their staff, finances, and legal compliance because of the national security law, adding, quote, Hong Kong's position as a free global financial center will suffer as a result of talent outflow, end quote. And he believes that 20% of Americans have already left in the past 2 years. The statements were made at a virtual event hosted by the Center of Strategic and International Studies, a US-based think tank. May also pointed to the decision last month of the Standing Committee of China's legislature that Hong Kong's leader and an oversight committee should be the ones to approve the use of an overseas lawyer in national security cases as evidence of further rule of law deterioration and the undermining of Hong Kong's independent judiciary. The comments provoked Beijing's foreign ministry to accuse May of willfully discrediting the city's business reputation, stating at a press event yesterday that May had, quote, vilified Hong Kong's rule of law and freedom, showed support for anti-China forces in Hong Kong, and talked down Hong Kong's development prospects, which only exposed his sinister intention of disrupting Hong Kong and containing China, end quote. Okay, next up, the Chinese economy, and first up, it seems that many investors are beginning to take notice of some of the positive preliminary consumption data for the Lunar New Year period, which we have been examining ourselves this week, as bullish bets grow across stocks in Hong Kong. With a supportive global equities backdrop, on the first day of trading after the Lunar New Year break, the benchmark Hang Seng Index jumped to its highest level in 11 months. The Hang Seng China Enterprises Index, which tracks mainland companies listed in Hong Kong, also jumped almost 3%. The Hang Seng Index, as well as the Hang Seng China Gauge, are set to rally for 6 straight weeks. Bloomberg's Hong Kong team writes that, quote, traders were emboldened by China's holiday travel and box office data, which showed a strong revival in demand and suggested the nation has emerged from the worst of a COVID-0 exit wave. Investors have been keeping an eye on consumption figures from the nation's most important holiday to gauge the strength of China's economic recovery, end quote. Other analysts agree. Quote, "We are tactically bullish on China stocks. I think what we might see in the months ahead is improvement in many of these activity indicators." End quote. Bloomberg analysts speculate that if the upbeat mood continues, the China Securities Index 300 benchmark may just enter a bull market when shares resume trading this Monday. We will need to see. But next up, we have more important developments on the Chinese economy. Hey guys, if you enjoyed today's episode of China Update, as always, don't forget to hit that like button. It's a massive help. It's also a huge help if you are not subscribed yet and you do like this sort of content, to subscribe and hit that bell notification. And anyone who can go that extra mile and be part of the community, that helps me continue making these episodes every day. Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. In a report published this week by Capital Economics titled "Lifting the Official Retirement Age is Not the Answer," Chief Asia economist Mark Williams argues, you guessed it, that raising China's retirement age will, quote, "not make a big difference to the size of the workforce." End quote. The report argues that the recent contraction in China's population has triggered renewed discussion of what the government could do to counter the demographic drag. One popular suggestion is to lift China's statutory retirement ages, which are very low, but raising them, it argues, would, quote, "keep relatively few older people in work, since most workers today keep working once they have passed retirement age," end quote. Only a quarter of men drop out of the workforce at that point. Indeed, quote, "despite how low the formal retirement thresholds are, the share of people aged over 65 in paid work is higher in China than it is in other major developed and emerging economies," end quote. One of the reasons for this may be because pension benefits in China are very modest. We remember that recent official data confirmed that China's aging crisis is deepening, with 280.04 million people aged over 60 at the end of 2022, up from 267.36 million people in 2021. An increase from 18.9% to 18.8% of the population. Now, mainstream demographers, both internationally and within China itself, believe there is a real possibility that China's official 1.4 billion population could halve by the end of the century, and policy tweaks to the pension age are not going to save China from this trend. The Capital Economics report concludes with, quote, "raising the pension age won't make a significant difference to the impact that population aging is having on the size of the workforce. Indeed, there is a good chance that average retirement ages will fall over the next few decades, even if the statutory requirement age is raised, as increasing affluence will leave fewer needing to stay in work past 65." End quote. Next up, the Global Development Policy Center also has an important new paper out. This one, simply titled "Small is Beautiful," is on China's development finance. The most notable finding in the report is the sharp fall in development financing from 2016 through 2021. Other key findings in the report include: 1. From 2008 through 2021, Chinese development finance investment committed almost $500 billion in development finance, 83% of what was lent by the World Bank in the same years. 2. China's development finance has been concentrated among its top 10 borrowers: Angola, Argentina, Bangladesh, Brazil, Ecuador, Iran, Kazakhstan, Pakistan, Russia, and Venezuela, 59% of total loan commitments. The top 3 sectors for China's development finance are extraction and pipelines, transport, and power, or 66% of total loan commitments. 4. At the same time, there has been a decline in lending to oil firms. And finally, as Chinese overseas development finance has fallen in total value, so too has the average loan commitment size, both in monetary value and in the geographic footprint of finance projects. The authors of the report suggest that this is at least partly because Beijing is moving towards funding smaller, better thought out projects, hence the name of the report, "Small is Beautiful." Not all commentators agree with this conclusion, however. Quote, "This isn't really what drove the huge decline in lending. I speak often to friends and former students involved in official development lending, and it was pretty clear in 2015-16 that the Venezuelan crisis came as a huge shock to Beijing and caused them completely to reevaluate the risk of their lending to developing countries. Before then, developing lending seemed something that Chinese lenders understood very little. After Venezuela and a few smaller coincidental problems, it became clear that what had driven previous lending was mostly their lack of experience. I expect we'll eventually see a partial recovery of Chinese development finance, but not to anywhere near previous levels. Beijing has learned that when liquidity and commodity prices are soaring, lending to developing countries may seem much less risky than it is." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. This week has been a relatively slow week because the country is on vacation. Because of this, there may not be an episode tomorrow, so just a heads up with that. Once again, thank you so much everybody for watching. Wherever you are, I hope you have a wonderful weekend, and I will see you on the next episode of China Update.